You're listening to the Ottawa Real Estate Podcast with your hosts, Paul Stevenson, David Warren, and Greg Campbell. Let's see what's going on in the world of real estate today.
Good morning, and welcome to the Ottawa Real Estate Podcast. My name is Paul Stevenson, and I am one of your hosts. I'm joined, as always, by David Warren and Greg Campbell.
Yeah.
We are here to bring you the latest and greatest in our nation's capital real estate market. Gentlemen, how are we doing? What's going on?
Good, Paul. What happened there? Are you off video now? I wanted to see you walking around.
Well, I was. Yeah, I don't think Steven had me in the actual video itself, but yes.
Okay. Well, it's okay. I like seeing
strolling through town. Beautiful. But yeah, no, it's been a wild week since we did our live show. I don't know about you guys, but pretty good feedback. I think people were happy just to hear what's happening in the market. The last 4 weeks, have been, I don't say tumultuous. I just wanted to say that word, tumultuous. But they have been great. I think people are a little worried, a little concerned. So I think just getting back in the saddle and giving everyone our take and a little update, I think maybe ease some minds. But what have you guys seen? What have you seen since our last show? What's happening?
Well, I've been quieter than normal. I'm handling a lot of calls and I'm meeting with a lot of people this week face to face just to talk about their current situation in terms of sellers anyways. I'm going to go see the properties, upgrades they've done, give them a realistic evaluation with the change in the market, and see where they sit. The one thing I am happy about is that these sellers that are calling me are probably about 6 months out from selling. So they're being very proactive in terms of wanting to make sure they understand what's happening now and where it may be going. I did a little breakdown of Barrhaven because I know it's been a while since we've done any stats on the show, obviously, since we haven't done the show. So this is pretty cool. So I took Barrhaven. I did a quick breakdown of townhomes and semis, focusing on the last 4 weeks plus the 4 weeks prior to that, and then versus 2022. So this is exclusively townhomes and semis throughout Barrhaven, 3+ bedrooms. So for July, for right now, there's 47 active with an average of 40 days on market at an average list price of $655. Conditionally sold, there's currently 8. Those ones average 28 days on market and a price of $615,000. And now sold, we had 28 sold in the last 4 weeks, averaging 23 days on market and an average price of $606,000. So active versus conditionally sold and sold is down about $50,000 in the last 4 weeks. So, it'll be interesting to see if those ones hovering at 655 are going to sell. They also have a higher days on market value. So the ones selling quicker are clearly listing lower to get it done. For whatever reason, those sellers are just more anxious to leave as opposed to hold. I think that some of the ones that are holding are going to either have to come off market, depending on their situation, or they're going to have to drop their price quite a bit. And that's something that we're starting to see for the properties that didn't sell over the last 5 months or so, when the market kind of started getting very active again. Now, in June, 48 homes were sold, averaging 17 days on market at an average price of $627. So that's a substantial difference, especially with days on market. 17 versus 23 to 40, and selling for $20,000 more on average than what sold in the last 4 weeks. That's a pretty big dip. And in 2022, only 25 sold in over the same period, averaging 26 days on market at an average price of $612,000. So, we were over 2022's numbers, and then now we are under. And I imagine that's going to go under a little bit more over the next until the fall.
Certainly with the rate hike doesn't help that, and
No.
Summer vacation, July, second half of July and August are typically very slow. Everyone's off camping and taking their vacation with their kids before they go back to school. but there was, with that latest rate hike, there's an article talking about it, that the average income needed to buy a home in Ottawa went up $4,600 with the last rate hike. So from $130,000 as an app for purchasing an average home to $134,600 with this latest rate hike. And kind of speaking to that, like you said, kind of diminishing that buying power, because obviously having that income is, if you're not qualifying, it's it's going to drive those prices down. Fewer people. I'm curious.
Yeah, it seems like that would be the short term, like the easiest adjustment with the rate hike is going to be prices. And I mean, Tiff even said that when he made the announcement. He said last time we raised rates, we saw a pretty substantial downtick in prices and transactions. So I mean, they know that doing that is going to have at least a short term, like you said, Greg, 3-4 weeks, I think, is kind of where it sits. I think, as you said, Dave, compounding that with summer months and people traveling and so on, I think it's just the perfect storm of let's wait, But again, like we said last week on the live show, I don't think it's going to deter people long term. I think it's more just a small readjustment,
Yeah, and then we'll see what happens in when's that next the next rate is supposed to be September.
Yeah.
So I wonder, and it's going to be interesting like the next few weeks, because are the people it's just so funny, man. People just how people react, right? It's like, are they waiting this long that long to see what's going to happen? Like, are people expecting it to go down so that the prices will, or they can sell, there'll be more buyers? Like, I don't know. It's such a funny thing to watch and understand. But like, I see, for the people that can do it, again, as we say every summer, there's lots of opportunities right now if you can buy. Always.
Yeah, being that the latest rate hike coincided with summer vacation, like we just said, it's typically a slow period anyways for sales, and prices kind of stagnate regardless for these couple of months. But coinciding with the rate hike, I don't know whether price drop in average prices or sales, kind of activity is due to the rate hike or just vacation or both, and so I think kind of the more telling will be after Labor Day, which is kind of prototypical of kids go back to school when families start looking at buying again. So I'm kind of curious as to see whether that kind of has that same sort of pickup in activity or not.
Yeah, it feels at least like very similar to last December. Like, it feels like this is kind of the dip or the calm before the storm. Like, again, I just don't see any way that prices remain on a dip. Again, I said last week that, there's a lot of that talk of that, what they call a dead cat bounce. Like, we saw prices really go up at the beginning of the year, and then they kind of came down slightly. And then, they're either going to go up substantially again, or they're going to plummet. So I just don't see any way that the latter can happen. So I think if, as you said, Greg, if you're a home buyer getting into the market or an existing homeowner and you want to, upgrade, now is, I think, one of the better times. Let's say if you looked at the next 5 years moving forward, this is going to be one of the best times in the next 5 years to buy. If you have it all rolled out, you look at 60 months. If you rank them all from 1 to 60, I mean, the next 2 to 3 months, I think, are going to have to be pretty close to the top of that chart as far if you're looking at just the price of homes. All things considered, as we said, rates are going to come down, prices are going to go up. It's cyclical. Everything is going to work the way it usually does. It's unpredictable as to when it's going to happen. But I just don't see any way prices are going to continue to drop. And if they do, then there's going to be a resistance there where investors or whoever are just going to be like, okay, well, you're going to put these at 500,000. We're just going to buy them all. People are like, there's also investors waiting for those opportunities as well. So I just don't see any way it can drop below a certain threshold. And I think we're seeing that dip right now based on, as you said, rates, summer vacation, et cetera. But I just don't see any way come September, October, November, like by the end of the year, that we're not seeing prices back on the rise. So
there was
Go ahead, Dave.
Oh, no, continue.
I was just going to say, are you guys seeing right now with the way that the rates are you finding that a lot of people are pushing for 5-year fixed yet, or are they still kind of banking on variable coming down and sticking with like 1, 2, 3-year fixed mortgages?
So definitely we get a lot of inquiries about 3 and 5 year. kind of in that same breath that, they're looking at the 3-year because they don't believe rates will stay as high and they don't want to lock in necessarily to the full 5 years. And they're hedging that they will come down. And then in that same breath, they're saying, well, what's their 5-year? Because I'm also uncertain of what rates are going to do. And I, kind of that stability for my budget is also, enticing. There's a lot of misinformation or uninformed borrowers that believe that what the Bank of Canada is doing with, adjusting bank prime or the overnight lending rate is directly connected with the fixed rate, which it isn't. And so kind of, that conversation always comes into play that it is, it does have an impact a little bit on the bond market, but that fixed rates are tied to the bonds. So I think that's where people are, they're weary because they keep seeing the Bank of Canada raising rates. And so they're worried about that. Obviously that's impacting a lot of things, but then they don't believe that it's going to stay elevated for an extended period of time. I don't know if Paul, you're seeing the same.
Yeah, it is a challenging conversation to navigate right now. I mean, I'll say to clients straight up, like, this is a challenging conversation to have because it is like nobody really knows where rates are going. If we've learned anything over the last 24 months or 18 months, even the experts saying what they say, it's not always accurate, if ever. So, I say if you're willing to take on any sort of rate risk right now, I still think I'm obviously very pro variable, and it becomes harder and harder to suggest it when there's a 1 to 1.25% difference from the fixed rates. But I'd say if you can take on any sort of rate risk, at least in my opinion, the likelihood of a variable rate staying at 6.3 for the next 5 years, I think is unlikely. I think the people that are locking into fixed rates, I think, are doing exactly what the banks are hoping. They know that there's a lot of people coming up for renewal. They know that they lost money over the pandemic with rates being at 1.25% and 1.5%. And I think locking a lot of people in at 5 years, 5.25%, 5.5% is excellent for lenders. I know they have to recruit them. That's by any means saying that they shouldn't be, they're a for-profit business. But I think once enough people have locked into those interest rates, that we'll start to see rates come down. Obviously, banks would never talk to regulators. That never happens. There's no conversations there. They're supposed to be independent. But these things tend to follow a certain trajectory, I guess. And I just feel like if you can take on rate risk, I think variable rate's going to be a good option. I think we will see variable rates come down before we see fixed rates come down. We were saying last week, maybe 9 to 12 months is the current prediction for variable rates to start decreasing. And yeah, I think the 2 and 3 year fixed, when those were really hot, probably 6 months ago, lenders sniffed it out. They're like, okay, 2 to 3 years are hot. Let's, those rates went up. They're sitting in the mid 6s now in most cases. You can probably get the 3 year still at maybe 609, 619, somewhere like that. But most 3 years, 2 years are sitting in like I've seen some at 659, 669. Like they're not cheap, at least compared to the 5 year fix. So from the calculations I've done for clients, looking at the 5 year fixed rate, let's say a promotional rate of 519 compared to a 3 year rate of 659, you'd have to have a rate of 2 or 3% in your last 2 years to even get to a break even point for the 5 year. So people are, if you take a 3 year fixed rate, you're going to pay a higher rate for the first 3 years in hopes that rates come down in 3 years. But if they don't, then you're basically pigeonholing yourself. So honestly, it is tough to navigate because I think it's a gamble either way. If you take a shorter term fixed rate, you're basically hoping or gambling that rates are going to come down. If you take a 5 year variable, you're hoping the rates come down. But both ways, unless you take a 5 year fix, you're kind of rolling the dice a bit. So it's challenging. You really got to know what clients are willing to take on and what the goals are. If they just want a fixed static payment and they're comfortable with it, obviously going fixed rate. But if they're willing to take on some rate risk and want to kind of play the game, then I would still feel comfortable putting people into a variable if they understand that.
I think a lot of people are, in this climate, very risk adverse. Prior to obviously any increase with prime and all of that. They, that is more challenging for them to, recognize that variable has, in the long term, has won out historically. But I think really the most important is just, the rate is whether you're going variable 3 year, 5 year, at the end of the day, whatever that rate is again, like we talked about last week. I'm mixing up whether it was last week or that other episode we did midweek of just budget, like it's fitting their budget. You know, regardless of what lender you're looking at, what rate, variable, fixed, term length, have it fit your budget for where you are, and like go with that, what you feel comfortable with. If there's an ounce of you that's uncomfortable with, you know, looking at a shorter term or looking at a variable, then don't do it, you know, because, you know, there is such uncertainty out there. There is no crystal ball. You got to go with what you're comfortable with and what fits your budget for where you are. And you can really kind of look at what's in front of you right now.
Important to note, Greg, I don't know if you knew this, but obviously, Dave, you know, whenever we place a client in a specific rate, like ultimately the choice is the client's, right? I mean, we're there to advise them and make our suggestions and professional opinions and so on. And, you know, typically clients they're coming to us for our advice. So they typically will at least put a heavy weighting into what we would suggest, but ultimately it's their decision. And when the time comes that they're signing their actual mortgage package, there's a document in there that's an actual suitability disclosure, like a suitability agreement. So saying that, you know, both the client and us find that the mortgage is suitable for their needs. So it is important that we understand what their needs are. And we're actually, you know, the clients are actually signing something saying that they agree that this mortgage product is suitable for what they're looking for. And if it's not suitable and they went against what we suggested, that's also documented. So it's very important if you're an advisor and you're listening to this, like it's very important to document your conversations, make notes of what you're saying. Talk to Greg about this today. So made this suggestion based on this. Like keep those notes, because if anything ever happens and the client says, "Oh well, you know, they forced me into a variable or they put me into a fix that I didn't want," you know, you have to be able to explain like, "Well, these are the conversations we had this date, that date, and this is why I suggested that," and be able to defend your position. You know.
Yeah, I think the disclosure documents are very important. Luca and I kind of started just a one sheet before we engage with buyers and sellers, just saying that this is, you know, just things that may happen along the way and things that you need to be prepared for. Because a lot of the time, you know, things will happen like that when it's, you know, people get excited. They're, you know, going into home ownership, talking to you guys about, you know, the rates, talking to us about the process. And a lot of people seem to forget some of the initial conversations. So I think it's very important for any advisor, I mean, in any business, to make sure that they've at least covered themselves and gone over certain elements of the process with people properly, and make sure that they know that they've actually read it, that they sign off on that.
It is a stressful time too, when you're going through, there's so many steps. We're so used to it, right? Like it's just literally another day at the office when we're going through these documents and processes. But for someone who's a first-time home buyer who's never gone through the process, like there's so many moving parts, inspections and meeting with the lawyer and, you know, dealing with going to see a house with Greg, getting pre-approved from Dave. Like there's a lot of things happening. So a lot of the times these conversations that you might have had, like you said, Greg, in your initial phone call, explaining something to them, clients don't remember that conversation necessarily. Some do, some don't, you know, and it's just really important to kind of reiterate these things and, you know, explain things in really clear and concise terms so that it's easier to consume for the client. But also, I like to put everything in an email and just bullet point it. Like, you know, this is what I need from you. These are the steps we're going to take. So it's super clean, super concise, and they can actually go back and reference it. So it's not like something they're just hearing over the phone and they have to try to remember this, 5 months later when they finally found the home they want. So they can actually go back and reference that. Oh, you know, Dave said these are the steps that we're going to have to take. We're going to do this, and we're going to get the inspection, and we're going to, you know, see our commitments and so on and so forth. So they actually have a reference point to go through the process, and they feel like they understand what's happening, you know.
I think as well for any realtor or mortgage agent is also to, like, I fully agree with both of you guys. You know, if you're having a conversation, follow it up with an email or a document that's outlining it for that buyer or borrower to reference, but also remove the jargon. You know, we get caught up being in the industry so often with just throwing out jargon and assuming that somebody knows what they're talking about. And to your point, well, first-time home buyers don't know. How many times do people move in their life? You know, they're not moving every week or even every 5 years or even every 10 years. They don't remember these processes, and the process and the steps change over time because regulations change of what's needed and new terms are like injected into kind of our vocabulary within the industry. So the best you can do is also not just explain it have it written down, but also in a clear and concise manner that is easy to understand and not just kind of jargony throughout everything.
Mm-hmm.
Yeah, I don't remember who it was. Some philosopher, I think, said something along the lines of like, basically the goal is to take a super complex issue and just make it as simple to understand as possible. Like use the most simplest reference or simile or analogy or whatever it is to basically get your point across in the most clear and digestible way.
Digestible.
I wanted to say too, what's that?
Digestible, yes.
We met last week with one of our lenders, actually, Pillar, who was awesome. They hosted the three of us on BHB Television, which is Brokers Helping Brokers, and Tony Cook, who works at Pillar. He ran us through kind of talking about the market and stuff, and it was a very interesting conversation. It was weird. I don't know how you guys felt, but it was weird for me, at least, to be on the other side of that and actually have someone asking us questions. Because typically, when we're doing these shows, like even now, if Greg's saying something or Dave's saying something, you're kind of trying to think of, okay, what's my response going to be? What are we going to talk about next? Your brain's kind of working in a different way. I find when someone's just asking you, it felt a lot more like just a natural conversation. Did you guys find that? Like,
yeah, it was good, and it was interesting being in a space, sitting all together and doing it like that. That was fun.
Yeah, well, when that comes out, which I think they said it's about 2 weeks or so, we'll actually should release it on our channel here so that people can actually see that. I mean, it's essentially us with Tony. It's Tony as a special guest, essentially on a real estate podcast.
Just somebody else filming it, videoing it.
Yeah. It'll be different editing, but it'll be similar.
Do you guys think it came up in conversation? I can't remember with who, but they were talking about the thought of rates going to 10%. Now, let's hypothetically, if that happens, what would happen to the market, do you guys think?
I mean, stall completely.
Right. And can it, how quickly can that, like the Bank of Canada, they can pretty much do whatever they want to, right? Just based on like how they
inflation,
feel the economy is doing, and inflation.
Based on how Tiff's feeling that morning,
right?
Yeah.
So for us to
off or not,
so for us to get like a rate hike of 1%, that's still possible. Most unlikely, but still possible, right?
Correct.
Yeah. Okay.
Very unlikely, but still possible. A lot of it also comes down to what our neighbors in the South do too.
Mm-hmm.
Like if the U.S. economy, their inflationary numbers are very entrenched and they continue to stay elevated, and so the Feds are having to raise their rates again. And if Canada doesn't, if there becomes such a disparity between the overnight lending rate, then it also affects like our currency, pegged against the US dollar. So there are other contributing factors that, like from outside the country, that will also drive what the Bank of Canada is doing. But it's I mean, it is. Is it possible? Yes. I wouldn't have said that 6% and 7% rates were possible, a year and a half ago.
Mm-hmm.
And here we are. So I'm not going to say that 10% is impossible as for fixed. But
that's exactly what I was thinking. Like after what we've seen the last, like with 10 rate hikes now, like another 10 isn't out of the, like, it's not impossible. It would seem very unlikely and improbable, but 10 also seems, if someone after the third rate hike was like, there's going to be 7 more between now and, July 2023, we would have said that's impossible. Like there's no way we can sustain that. So who knows?
Interesting to see that, like the value, home value, like the prices,
Mm-hmm.
It's kind of like, I try to compare it to sometimes where, if you have a condo for sale and the fees go up substantially, the actual sale price of the condo will fall a bit.
Mm-hmm.
And I guess it's the same thing. Like the rates go up, the prices come down, and it could be a significant drop depending on how high that is.
Now, I will say though, at the same time, that there are a large percentage of borrowers that are actually paying 8% to 12% on their mortgage rates because they've been forced, because they don't qualify under the conventional big bank or, a bank qualifying, they're pushed into the B space. So that, you got the A, your traditional, lenders. You then have a B space, which is typically rates are about 1% higher. They have more flexible qualifying criteria. But then you have you're then into mix, which is kind of your C. And then you have private. So mix or mortgage investment corporations, their rates right now are anywhere from, on a MIC is anywhere from typically 7.5 to 10%. And private money, you're looking at typically 9 to 12% as on first mortgages. And there's a huge population there. And we were talking about with Pillar, with Tony this past week, because Pillar is a MIC. They traditionally lend in construction for construction financing, but they are a MIC and they do lend, pretty strongly. And he was saying how popular, even the alternative conference was that he went to in Toronto. Right. It was sold out with a huge waiting list because there is such a demand in that space because of qualifying, and people are still able to come up with those payments on that. How long they can, right. That obviously is a concern. Typically it's borrowers for short term with an exit strategy. But there is a huge and growing market of people paying in that higher rate. So
yeah, that's a lot. I wonder what I wonder if there's a way to find the numbers on that. It'd be interesting to find out, like, what A lender, B lender, C, whatever.
Like from a dollar amount lending per year.
Well, just to see the percentage, like of
percentage of who's in what type.
Yeah. Who's in what type.
In that alternative space, in the MIC and private space, it's billions of dollars in Canada. There's a medium size, medium size, like Ottawa-based MICs are in the 500 and 600 million that they have under management. And that's without getting into Toronto or Vancouver or Calgary or any of those where they're even larger. And that's just one institution, or not even an institution, but one lender. It's a really large space. It's surprising to a lot of people how big it is.
I noticed recently too, I was looking at, Greg, I kind of mentioned this to you last week, but I had a client who was with an alternative lender for the last year. And typically those lenders are doing shorter terms, right? Like 1, 2, maybe 3-year terms. And often their rates are based on credit scores and things like that. So I've seen some B lenders that still have rates at, 699, 709, when fixed rates on the A side, for a 3-year sitting at 659, 669. So, I mean, there's not too much of a difference there. But I had a client that was getting offered, I won't mention lenders just for the sake of, anonymity. But basically, they were with an alternative lender. They were being offered over 8% for renewal, for basically 1 year plus a renewal fee plus, plus. And basically was looking at getting them back over the A space and was able to do so with a lender that made like an outrageous exception. Debt ratios were at over 80%. And the lender based their approval on the pre-existing relationship that the client had with the lender. Wow. So they went in, luckily, they had their business accounts and so on with the lender, which really helped. But to know that banks are making those sorts of exceptions based on relationship is, I think, really important for people to know, because I think a lot of people, they might get a renewal notice and just assume that's all their only option. Like that's all they have, right? Is, okay, well, I better just sign this and move on. But there are often other options, better options available. And that's, I think, where Dave and I can really assist people is in exactly just navigating those waters. And just because you're not a home buyer, even if you're renewing or you're looking to refinance, like these are really important conversations to navigate properly, because that extra, if you pay an extra 1.5% for another year, that's tens of thousands of dollars he's paying extra in interest. So these things make a huge difference, and it's really important when it comes time to renew, especially if you're with these alternative lenders, to see, is there an option to come back to the A side? And typically those lenders want that too, right? They're kind of giving you a short-term solution in hopes that in a year or two you can get back over to kind of an A lender and get back into that A space and lower rates. So,
and just for the listeners that may not know, the that number you were just saying, the debt ratio for 82% was like 80%.
It's supposed to be 44.
Yes, 44, right? That's the average. Yeah. So that's substantial.
That's the max. So it's kind of like two numbers that we look at, and again, like I said, I was saying on the show last week that clients are much more informed now. Like clients understand all these numbers, so when you're explaining it to them, like it's actually resonating. They understand what impact different payments and so on have on their numbers and their qualifying. But that number, that 44%, is kind of like, that's, the new mortgage payment as well as all of your existing debt. So if you have that car loan, you have that line of credit, that's student debt, something that's kind of lingering or that you haven't paid off or that you just took on, that's massively impacting your qualifying. And, as we mentioned on the show too, we're qualifying you at that, whatever your rate is, plus 2% because of the stress test. So, it's really important to have your finances in order. Like we were saying the other day, like cash is king right now, especially. Paying down those high interest rate debts is very important right now, because you're going to save more that way than investing, right now. So, so if you're sitting on cash, I would recommend putting that towards high interest debt if you have it. And again, that's going to better your position for buying and renewing and refinancing or what have you, but also it's going to save you a lot of interest long term.
I want to also clarify on that when Paul's mentioned that 80% debt ratio of getting that that approved. Typically, for those, they're looking at either net worth. So there's specialty programs for net worth, having a certain amount of liquid cash, whether that be investments, unsecured or secured or registered rather. Not equity. They're not looking at equity in homes because that debt needs to be serviced. They're looking at like what you have liquid, or to Paul's client case, they've got their business account. So they're also typically self-employed in that case. And there are different self-employed programs where they're using the net income of the business as opposed to what they're just claiming on their taxes. So in a lot of cases, like in those cases where it's kind of making that exception, it's not just you're a salaried employee, with, 10,000 in savings and you go in with your like letter of employment for 50,000, you're not going to get that 80% TDS exception. It's going to be, you're having to fall under one of these specialty programs. Just want to clarify so people aren't calling us up and saying and expecting outrageous ratios.
Why can't you do that for me?
Yeah. Paul, I don't know what you're doing right now. There's a lot of palm there.
Oh, sorry.
Leaving the lens.
Oh no, I was looking for mood boosts.
I didn't know, right?
You guys high and dry over there.
Do you have them? Do you have them? I love it. Looks pretty amazing right there.
Let's do it.
The sun is coming up.
It's it's early morning. It's slow moving here in the morning apparently. So we'll see. It'll kick into gear. Okay, so let me see here. I'll keep my palm out of the frame. All right, so number one. Sad news today, gentlemen. The creator of autocorrect has died. Restaurant in peace.
Yes.
It looks better when it's written because it's actually PIECE. Anyways, number two. I have the attention of a goldfish. It's been watching me for hours. Just creeping. Just creeping.
Better.
My personal favorite, number three. A couple of cows were smoking weed and playing poker. The stakes were high.
That'll wrap it up there. Yeah.
Getting lit in the pasture. Yeah. So we will be back now consistently Tuesday mornings, 10 a.m. We're going to get these shows out to you. If you haven't already, make sure to subscribe on YouTube, obviously, and whatever streaming platform you're listening to on. And gentlemen, any closing remarks? Anything you want to leave our listeners with this week?
No, just if anyone has any questions, feel free to give me a call. I'm doing a lot of research in the market lately in all sorts of neighborhoods across the city. So if anyone has any questions or wants to know about listing their property,
and you got that beautiful property in Campbell. I saw you posting about that this weekend. Open house.
Yeah, I got a listing in Campbell. It's a pretty nice. It's perfect for an investment, and perfect for a multi-generational family to to live in. There's 2 units and there's a little office in the back. You can run a home-based business out of there. Had a pretty busy open house on Saturday, but it's there. 14-16 Clothier Street West, everyone. Check that out. Campbell.
Clothier.
Clothier. First I saw it, I was like, is it Clotier? Like, is that a French spelling style? No, it's Clothier. Like, all the clothiers like back in the day, 100 years ago. What do you do? I'm a clothier.
It's cold. Put on
I
your
make
clothing.
or I import clothing. Yeah, I clothe people. The clothier. Yeah, great name.
I could see Greg. Greg would be. What would your job be, Greg? In like back in the
It would
you know,
be- I'd
2,000
be a
years ago, you'd be a clother,
clothier
clothier, or cape maker. One of the two. Okay?
or cake maker. Yeah.
Yeah. All right, guys. Well, have a great week. Thanks everyone for listening. We'll be back, and give us a shout if you need help. Hello, world champ. World champ.
All right.
All right, guys. Have a great week.
Deuces.
See ya.
Bye, guys.
Thanks for tuning in, everyone. We hope you enjoyed today's episode. Please remember to like, share, comment, and subscribe because we'd really like that.